Okay. Good morning, guys. What we looked yesterday at was the introduction to management accounting. Today we are moving for introduction to cost accounting. So you can look at it this as like management accounting is the complete field of study or the whole major subject, while cost accounting is a technique. Okay. In general, like cost accounting is a subject among itself too. Like there are many things to learn, but for our syllabus, cost accounting is a technique we need to learn or a method. So what does cost accounting do? Uh, it says the definition here is it involves the techniques and process of measuring, recording, and reporting the cost associated with a product or service. Okay, so the techniques and process of measuring, recording, and reporting the cost associated with a product or service. Any cost that is associated with a product has to be measured and recorded and then compared to the final product or the sales price of your product in order to determine what kind of or what amount of profits your business is making. So here's the definition by the Chartered Institute of Management Accountants in London. So it says the cost accounting is the process of accounting for cost from the point at which expenditure is incurred or committed to establishment of its ultimate relationship with cost units. So this definition says that cost accounting only relates to units that are related to a business. Okay, if any cost is not related to the final product or the units that you're producing, then it is not recorded. So the functions of cost accounting, they are cost finding, recording, analysis, and reporting. So just like journal entry system or the financial accounting system that we saw, we find transaction first, we record it, then we analyze, and then we report it. Okay. Analysis comes actually later on. Reporting comes first. So we can write it that way, that analysis will be later, reporting will be the first. So just like financial accounting, finding, recording, reporting, and analyzing. Reporting in this case, as we discussed yesterday, is only to the internal management. Cost accounting or cost accounting costs that are recorded and reported are not reported to government, or nobody files the taxes or their taxes based on that cost. So they are just for the internal management to view and analyze the company's performance. So the reporting would be like from a junior manager to maybe a senior manager regarding cost accountancy. So finding is searching for cost. So first of all, you have to determine whether a cost is related to the product or not. Yeah, that's the thing here. The cost has to be related to the product, not to the business. Okay, some of the costs may be related to business, but they may not be related to the product at all. So that's so something that happens in cost accounting is you have to find transactions that are related to a product or a service in a business that has many products or service. So you will have to find ones that are related to the product you are accounting for while other products will be ignored for this process. Then we record them, then there is reporting, and then there is analysis. Analysis meaning how your costs are performing, what percentage of your final product price is your cost. Analysis will try to determine or try to find out steps where your cost is high and low, and then reduce them accordingly. So what are the objectives of cost accounting? First is the ascertainment of the cost of production for every unit, every job operation, process department, or service. Okay, so sometimes you will have to determine the cost of production or the cost of a particular unit. Let's say somebody is a soap manufacturer. Now, soap is a really small thing in business, right? They can be produced at a really high rate again and again. And cost department can actually, through their process, determine what the cost of one unit of soap is. So that is the ability to determine the cost of production for one unit. Then there is the job operations. Let's say the company has many products. So they are producing a number of lines of products in a same plant or maybe in different production plants. So cost might even be determined for a particular operation. So let's say companies like Procter and Gamble that we saw in our marketing course, they have a lot of products. They could have like 100 to 200 products being produced. And a particular time, like one production plant in somewhere in the country could be producing like 5 to 6, maybe a dozen products in the same place. And in that place, cost can be determined for each operation separately. Sometimes this is also common in steel manufacturing companies. For example, companies that produce steel rods that are used in construction. So they will have different sizes of rods. Like there is a half a inch rod, then there is 1 inch broad, then there is 3/4, 1.5 quarter. There are different sizes of rods, how broad they are. So these are different departments of the same company, different different departments of the same company that are producing different sizes of seals. So now the different job operation can give out the cost as to, let's say, the per ton production cost for, let's say, the smaller size of steel is highest, and for a broader size of steel it's lower because it has to consume more steel for the process. The prices are lower. Then there is process department. Process is the same. Sorry, it's not the same. Process department could be, let's say, there is a production line. Okay, like somebody manufacturing a car. Yeah, so car production lines would have process departments. So there is like a drivetrain section, there is a body section, and then there is the electronic section. And then there might be a fourth called the interior section. So all these four departments work separately. And drivetrain is only related with the engine and the transmission of the car. The body section would be about the outside body and chassis of the car. The interior would be about seats, steering, the looks of the car and color of the car, while electronic section would be about the stereo system, the car interactive system in the car, and screens installed inside. So there will be four different departments, let's say, for a car. And then cost accounting will sometimes have a task to determine the cost for each department separately, not all together in one place, but separately for each other. And then there is service. Service costing is when the business does not have a production, or it's not a manufacturing business, it's a service business. Let's say like telecom service providers. Okay, now telecom service providers and then transportation service providers. They do not produce anything. They provide a service to some other people. They connect calls on telephones between people. That's one service. The second could be they provide transportation, that is just moving goods or products from one place to another place. So it's a service, and they have their own cost, and they have to also determine like per call or per uh, trip of transportation what their cost is. As we know that companies normally in Canada do not charge for per call, like making one call. The cost mostly charged are on a monthly basis. So how do they manage their business if there is no calling charges inside Canada? Like many other markets have a calling charge. If you call somebody, there will be a charge on that. But in Canada, there is not. Okay, so that will be service costing as to what their inputs are. Determination of selling price of products or services. That's objective number second. Only once you know what the cost of the product is, can you determine what the price of the product should be. Okay, ideally speaking, the price of the product will be determined after you know what the costs are. Without that, you cannot. But in the reality in the market, sometimes the prices are determined by competition. Okay, so your business or any business will have a competition, and there will be other people doing the same thing or producing the same products. In that case, pricing will be determined in the market. So what happens is in the market, if you can compete with what the prices competitors are selling for, then your price is correct. Whereas if you can't sell, then the price is incorrect. So that makes selling price of product or determination of selling price difficult, because you have to take the price that is offered by the market and then produce your product at a lower price than that in order to make a profit. So, but in the cost accounting world, you can still determine selling price depending on cost accounting. For example, you determine that the production price of something is let's say $10.8. So you determine it's 10.8. Then looking for your other inputs like rent for the plant and salary for the manager, everything. You determine that you want to sell the product for $14. Okay, 10.8 was the cost, and you determine to sell for 14. That can be done using cost accounting, but ideally what is done is uh, the market will give the price. The market will say that the product that you produce is sold for $12. Most of the competitors sell in the range 11.5 to let's say $13, in that range. So in that case, you have to sell for the same price, maintain below that. In development of budgets. So standards and budgets. Standard is something that would generally be the cost of a product. Standard is, or a standard could be for a product, for the time taken, for production, for profit margin, everything could have a standard. As to, let's say if you employ 5 people on a production line to work on a particular product, how much unit or how many units can they deliver in an hour? Let's say how many units they can deliver in an hour could be the standard, sorry, could be their capacity. Then there would be a standard capacity. Just like we discussed yesterday, like if there is a plant mixer, okay, so manufacturing plants have a mixer for their chemicals or the products, and there is 100% capacity for that. Sometimes the standard would be 100%, that whatever the 100% capacity for this thing is, that's the standard. Sometimes the standards are higher. So sometimes the standard capacity would be considered, let's say 110 or maybe 120%. So standard is something that is set by the management, that we want this much average or this much average performance from the particular department. or the standard price would be that sorry, standard cost would be, we want the production to happen or the cost to be controlled at X price level. So let's say 10.8 as we saw for one product. So if the company says we want to control it at $10.8, then that becomes the standard price. And then the performance of company will be analyzed against the standard. Some departments or some things will be performing at better terms than the standard, and some departments will be performing at lower terms than the standard. Then the company or businesses know which department they have to control. Like sales department, if somebody is working in sales, they have a standard of performance as to how much product should be sold every month. So they will get a target for monthly sales of the products, and that becomes the standard sales target. If you perform more than that, or if somebody sells more than that, then they are given incentives, promotions, and bonuses. Okay, so that is a standard. And budget is something the company thinks will happen. Okay, so standard is what ideally should be happening, and budget is what the company thinks is actually going to happen. So the difference is standards are generally always there, that any time of the year the standard of production will be at a particular level, or the standard of cost will be at a particular level. But budget will be determined after every period. So maybe after a 6-month period, maybe on a monthly basis, maybe on a yearly basis, the company will constantly keep determining what their budgeted expenses are and their budgeted incomes are. So I believe everyone knows what's budget. Okay, we know we make a budget for our house expenses too. So a budget is you try to determine beforehand what your expenses and incomes are going to be. So instead of waiting for the time to arrive, you try to make a limited amount of guess as to what is going to happen. So that is a budget. So similarly, companies also do the same thing. They will try to make a guess figure of what they think is going to happen in the company, of what they think the costs are going to be. For example, airline companies would have a big part of the budget depending on what the fuel prices are. So, or how the fuel prices are going to be in the future. So what normally companies or such size of companies do is they will have hedging contracts. So these are contracts like, let's say I have a budgeted price of my airline ticket, okay, or a budgeted cost for the airline tickets. That is dependent on what the fuel price of jet fuel or the airline fuel is today. So depending on what the price of airline fuel today is, I can fix the prices of my tickets for the next, let's say 3 months. But what happens if the prices of oil change? If what happens if the price of oil changes during that time, then my business will suffer losses. So sometimes what, or many times what big companies do is they'll make a pre-contract with oil suppliers, or make what they are called as a futures contract, a future contract to buy oil at a fixed price for the next 3 months. So doesn't matter if the price of oil goes up or down, the company will get it at a determined price, while the other party has to bear the risk of where oil prices go. So that is a part of the budget or the cost control measures for that company. So now that you have made a contract with your supplier that oil or fuel will be supplied to your airlines at a particular price for the next 3 months, not depending on what the price of oil is in international market, then your company can go ahead and make a budget as to what your cost is going to be for the next 3 months. So this is normally in the hands of the cost department or the cost management department to make these contracts when purchasing products. So similarly, like oil contracts for airlines, the construction companies or house manufacturers or house makers, sorry, would have contracts for timber and wood that is used for house framing and building. So every company has a contract. Now, so yeah, third point is that cost accounting leads to development of standards as to how the company should be performing and budgets as what they think is going to happen in the near or distant future. Point number 4 is assistance to management in planning and decision making. So we are looking at many points again and again here. Planning and decision making can only be done when information is available, right? So cost department or the production department or the service department will have a cost sheet for a business. A cost sheet is like these are your incomes, these are the products that you will be selling, and these are the cost. This is what my production department or my service department had spent on the business in the last 1 month. So they will create a cost sheet, and then the management will look at it and make their plans and decisions according to it. So the cost sheet will explain how one particular expense or a particular category of expenses are increasing or decreasing. So if you remember the income statement that we saw in financial statements, that is something similar to a cost statement. The production department or service department will give. It will have all the expenses uh, discriminated, like the cost of sales will be expenses related to the production on the top, and then there will be other costs that are not related directly to the product at the bottom. Point number 5 is reduction cost and maximization of profit, reduction of cost. Which is an obvious objective for any business, since profit is income minus expenses. So there are only two ways to increase your profit: either decrease your expenses or increase your income. So since prices in the market are dictated by the market as to what people can sell the product for, in a competitive market, the market will dictate as to what the price of the product should be. Given that companies have little choice as to what their income will be, they have more choice as to what their cost will be. That's why many manufacturing companies and big brands or any businesses, they focus on reduction of cost rather than increase of income. If they can sell for a higher price, they will, but most times that option is not available. The meaning of cost. Now there are different types of cost in a business. We have seen many of these during economics, and they have the same meaning here, but just that in accounting we will be calculating them at different stages. So meaning of costs, or the different types of cost that exist. So firstly, we have heard about what fixed cost and variable cost are. Now we will come to that, I think, next page later on. Okay, first, I think it's important to discuss what fixed and variable costs are. Fixed costs, as we discussed during economics, are costs that do not change with your level of business. So no, doesn't matter how high or low capacity your business is running at, fixed cost will always be there. Like the rent of the building, the salary of your manager, then other costs like the garbage services, the municipal services that pick out the garbage from your unit, your car insurance, These things are fixed costs. Doesn't matter if you use the product or if you are doing production or you're not doing it. Fixed cost will always be there. Okay, so they do not cease to exist, and they continue to be incurred as long as your business is existing. So those are fixed costs. Variable costs, on the other hand, are costs that will change according to your business. When you have more business, the variable cost will be higher. When you have less business, variable cost will be lower. Like electricity used. So if your production is not running at full capacity, you will be using less electricity. So that becomes a variable cost. When your business is running at full capacity, you'll be using more power and electricity. So that makes it a variable cost. Similarly, the raw material used for your production. So obviously, when you have higher sales, you will require more raw material, right? When the sales are low or the products are not selling very easily, your production will be low, and as a result, your uh, raw material consumption will also be lower. Right. So first, you have to understand what fixed and variable costs are. Those are the two. Then you can determine what total cost is. Total cost is just the addition of these two costs. So you have your fixed cost and you have your variable costs. If you add both of them, what you get is the total cost of business. There is something called a semi-variable cost, or costs that are not completely variable and not completely fixed. For example, your telephone bill. So sometimes the telephone bill is not fixed. It depends on your usage. There is a fixed monthly rental to it, that as long as you are using telephone services, this is the fixed monthly charge. And then there is a variable cost. When you make calls, there will be an additional charge. So it used to be a common situation before. Nowadays it has changed. Okay, so nowadays it's not the same thing, but telephone bills are example of a semi-variable cost, something that is not entirely variable and something that is also not entirely fixed. Part of your telephone bill is fixed, that is the monthly rental, and part of it is variable. If you use a service too much, there will be additional cost for the product or for the service. So just like a utility bill for your home, the garbage expense and part of your electricity expenses are fixed. They will be there every month. Whereas some expenses will change as to how much gas, electricity, or water you use, the bill will be variable. So you will never be getting a zero bill. If your house is closed and you're not using any electricity, you will still not be getting a zero bill. Your bill still will be a positive amount. But when you use, the amount will keep increasing. So that is an example of a semi-variable cost. So what we looked at up till now is the meaning of fixed costs, costs that do not change with your business. Then variable cost, costs that change according to how much business you are doing. And then we looked at semi-variable cost, costs that are neither completely fixed, neither completely variable. Total cost is the sum of these two. So every expense that a company incurs, if you add them all together, that is the total cost. So here it says sum of all the expenses incurred in the production, sale, or distribution of goods and services. So all the expenses put together are total costs. That's simple to understand. Whereas fixed cost and variable cost need discrimination or determination. Marginal cost. I believe everyone remembers from our economics syllabus module what marginal costs are, right? Cost or the change in cost when your unit of production or unit of input changes by 1. So we saw during economics that if you change the amount of labor working on the production, the number of people working on a production by 1, how does the production change? Does it increase or does it decrease? If your production increases at a higher rate than your last unit, then we say that there is an increasing marginal returns. That is the addition of a new laborer increased your business at a higher capacity than the last person that was added. Whereas if it does not increase at that rate, there are diminishing marginal returns. That is, the additional person that you added did not add equal amount of capacity to your company. It did add capacity, but it was not equal to adding 1%. It was less than that. So we remember what marginal and diminishing, increasing and diminishing marginal returns are. And we also know what negative marginal returns are. If with the addition of one labor, the production decreases instead of increasing, that is called the negative marginal returns. So the same thing applies here for marginal, or the same definition is used, right? Marginal cost, the total cost that varies when the volume of production is increased or decreased by 1 unit. So instead of looking at labor and cost, now we are looking at, labor and output, we are looking at cost and volume. So if you increase your volume by 1 unit, let's say a production line that produces 100 cars every day. So there's a production line that is able to manufacture 100 cars in 1 day. And given assuming a situation where the company can now produce 101 cars in a day instead of 100, 101, then what will be the change in cost due to that? Okay, so if you're producing 101 cars, if your cost of production will increase higher than that or lower than that, that is your marginal cost. So just like we were looking at labor in economics, is one person shop floor, how much production increase. Here, if you increase your production by 1 unit, how much costs are increasing? Okay, so we looked at fixed cost, variable cost, semi-variable cost, total cost, and marginal cost. Those are the major costs that we have to look at again and again during cost accounting. Then there is standard cost. So these are more complicated terms about cost. Once you determine the last 5 that we saw, then these could be understood properly. Standard cost. It is a target at which a business should aim. It is an estimate towards which actual performance are pulled up. So standard is like a target. So it is like setting the standard. The term is used many times as setting the standard for a particular thing. Setting the standard means you are setting up the expectation how everyone should be performing. That's the same thing with companies. If you're setting a cost standard, it means that you're setting a level at which your cost should be at all times. So it is the target or the standard or the target cost that your business intends to achieve. That's the standard cost. Then there is the conversion cost, the aggregate of direct wages and production overheads applied over raw material. So conversion cost is, let's say if it's a manufacturing company, what is the cost of converting your raw material into the finished product, right? So let's say for toothpaste, you have some chemicals that includes like mint, maybe calcium, could be fluoride, and other chemicals mixed together, and the toothpaste is produced. So conversion cost is what is the price to convert all these chemicals in different situations and mixing them together to create one toothpaste. That is the conversion cost. Or for a car, it would be the cost of converting the aluminum, sorry, aluminum, that is the raw material, into structure that is a car, right? So what is the cost for that? That is the conversion cost. Converting your raw material into a finished product using the company's processes. Okay. So that's conversion cost. Analysis and classification of costs. Classification by the nature of cost. So these are the types of cost that you will generally see in a cost sheet. When you're calculating costs, these are the general cost you will see. So one is direct cost, then there is indirect costs, direct labor, direct material, direct expenses, and indirect expenses. So what is direct and indirect in this case? So if you remember our income statement that we solved for financial statements in the last module, every cost that is included in the cost of sales is a direct cost, like direct labor, direct material expenses. Everything that is included below that in the operational expenses, operating expenses, they are indirect costs. So if you remember our income statement from the last problem we solved, here are our expenses, and they are distributed in two sections. As I told you during the solution, or when we solve these, that all the expenses on the top here, that is the cost of sales, they are direct expenses, and the ones below, operating expenses, are indirect expenses. And we know that cost of sales are expenses that are incurred for the production of your business. So if you have a manufacturing plant or a manufacturing unit that produces something, all the costs incurred in that manufacturing unit or in that production plant are your direct costs or cost of sales. Whereas expenses that are incurred out of it, that are not directly related to your production, but they are necessary for your business, they are called indirect costs. So for simpler understanding, when we were solving our income statements, the cost of sales that we had on the top are direct costs, and the operating expenses that we have on the bottom, they are indirect cost. So direct cost and indirect cost, and everything else mentioned here are subtypes of those, like direct labor and indirect labor. So direct labor is the number of people company uses, or the money that company pays to the people who work in your production department or in your service department. So let's say if it's a transportation service company. So transportation service company, the direct labor would be the people who drive the trucks or the semis. So the people who drive the semi are a direct cost for that company. Whereas the people that work in the transportation office to receive calls, to book orders, and do the marketing and sales for the company, they are indirect labor. They do not have anything directly to do with transporting the product from one place to another. So they are not transporter, they are there to operate the business. Hence, they are indirect labor. Whereas the people that operate the semis, that work in the warehouse to load and unload the semis, they are direct labors. They are working on the business that is transporting the product from one place to another. Okay, then direct material and indirect material. So material that is used inside your production plant or in the service of your business, that would be direct material. So if you have, again, let's say the example of a transportation company, it's in service, right? So what's the direct material for a service company like transportation? The fuel consumed to take product from one place to another, that is a direct material consumed. So direct material for a transportation company is the fuel, whereas indirect material would be like office supplies. Then other direct material would be tires. So the semis need constant replacement of their tires at some distance. So tires become a direct material for your company. It is consumed in transporting the goods from one place to other, right? Whereas the office supplies do not transport your goods. Office supplies are necessary for operating your business, but they do not move the goods from one place to another. The diesel in the semi and the tires they have, they move the products, so they are direct materials, whereas other things are indirect material. So for the cost accounting, we need to remember that these things are called direct and indirect. For our income statement, they were called cost of sales and operating expenses. It's just that cost accounting uses a different name for that. Some companies may be using the same name in their management, but generally this is how they are classified. Okay, then direct expenses and indirect expenses are any other expense, like utility, electricity, or yeah, utility. Let's say it's a production plant for soap, where soap is manufactured. So the electricity that is consumed on the shop floor where they manufacture soap is a direct expense, whereas the electricity that is consumed in the office of the company, or yeah, in the headquarters outside in the city, that is a indirect expense. So the electricity consumed in the offices does not convert raw material into soap. The direct expenses or the electricity consumed inside the production plant converts the raw material into soap. So that is a direct expense. Okay, so we will keep coming back to this again and again when we are solving problems. But remember that direct costs are something that are used for your business, for running your business, or for operating the core services of your business. Whereas indirect costs are not directly related to your business. You still incur them, but uh, they are not used to convert your raw material to the finished product. So that is one classification. Okay, then there are other classifications too. One is a classification on the basis of nature. That is material cost, labor cost, and other expenses. On the basis of nature, material costs are the cost of raw material or the tangible things that you consume. Now, what are tangible things? Something that you can hold, see, smell, touch with your senses. That is a tangible thing. So if something is consumed in your business, that is material cost. Labor cost is the service that your laborers provide or the people provide to your business. So the labor cost is strength of your arms or the strength of your mind. So if somebody is hired for their strength, let's say on the production department, if somebody, or let's say in a warehouse, somebody has to move the pallets from one place to another or move them from one line to another. So the company is using your physical strength and paying you for that. That is a labor cost. Whereas people that do accounting and receive calls at the reception, and provide other services that require only the mind. Those are also services or labor costs for the company. So any person providing the strength of their arms or the strength of their mind towards the business is a labor cost. So there is a material cost, anything that the business consume, anything. Okay, and labor is the persons that are used in a business. Other expenses than that could be like utility expenses, and sorry, transportation expenses, could be telephone expenses. Those are all different expenses. So on the basis of nature, two major expenses for any company or any business are that they consume and the people that are. Other expenses are very smaller than that. Then comes the function. Production expense, administration expense, selling, and then distribution expense. Okay, so production is the expenses of converting your raw material into the finished product. That is production. So every expense that you spent or every amount of money that you expenses will still be there. They will not change. Okay. So for example, if somebody has a restaurant, okay, so in a restaurant there are people working. There is a manager, there is a cashier, there is a cook, or maybe more than one cook inside the kitchen, and then there are people who serve, the people who wait tables, right? So these are the fixed expenses for the restaurant business. If a customer arrives or it doesn't arrive, these people have to be paid. Every one of them, the servers, the manager, the cooks, and the cashier, all have to be paid for the services, even if there is no customer in the business. Whereas even if there is more customers to the business, they will still be paid the same. So that becomes a fixed cost. It does not change whether you have more business, less business, or no business. That is a fixed cost. Variable cost is something that will be varying according to the size of business or according to more business you have. Like cleaning services. So the more your restaurant is busy, the more cleaning services you will require. Then the raw material, like let's say meat, and then vegetables, spices, oil consumed in the kitchen, then heating gas if it is required in the kitchen. These are all variable expenses. The more customers you get, the more of these things you will require. The less customers you get, the less you will require those things. Then there are semi-variable expenses. Semi-variable expenses are, as I told you before, something that has a fixed and variable component. For example, your utility bill for any business or any house includes a fixed component. That is, your utility bill will never be zero. Even if you keep your house closed, your utility bill will still be having some amount of money to it. And if you use the service more, that is, if you live at house, you turn on the heating higher, you use more water, electricity for your different works, then your utility bill will be higher. So this is a kind of expense that is never zero. Even if you don't use the services, you still have an expense, whereas if you use the services, your expenses become higher. So that's on the basis of variability. There are three types of expenses: fixed, variable, and semi-variable. Then on the basis of normality, normal and abnormal expenses. So what they mean here is normal expenses are expenses that were expected. Okay. So if something was expected, this money will be spent or this cost will be required, then that is a normal cost. Where if a cost was not expected, that is, if you did not expect that a particular cost will occur, then that becomes an abnormal cost. So normal costs are something or some place where you're spending money normally. You know that every month you're going to have a raw material expense, you're going to have labor expenses, you're going to have salaries, transportation, telephone expense, office supplies, All these things are normal and expected by the business every month. So they become normal expenses. Something that is not expected and maybe happens once in a while becomes an abnormal expense. For example, like machinery breakdown. If the machinery breakdowns and stops working, that is an abnormal expense to repair that machine. So breakdowns do not happen consistently again and again. They may happen once in a while, or if there is a fault with the machine, only then. Many times when the machine is inside a warranty, they do not happen because the service provider has the maintenance for that machine covered with them. So abnormal expenses are something that the business does not expect, but they happen sometimes. For example, if there is a theft inside the company, if there is a fire, fire hazard at the company, and part of the production capacity is destroyed due to fire, the expenses of that become a normal expense for the company. Insurance will cover the expense, but insurance doesn't cover 100% of your loss. So insurance will make a calculation, and sometimes they will have it like 92% or maybe 90%, sometimes could be 80% of your loss will be covered by insurance, while 20% you have to bear on yourself. So that becomes a abnormal cost for company. So normal is something that was expected, and abnormal is something that was not expected, but it still happened. Then cost on the basis of controllability and decision making. So if the cost can be controlled and decisions can be made about it, there are controllable costs, costs that you can reduce or increase. For example, quality of raw material that you want to use. Whenever manufacturing something, there are different qualities of material that are available. For example, even if you're using plastic to manufacture something, there are different kinds of plastic available, and there are different kinds of paints for the plastic available. Sometimes there is colored plastic, sometimes the paint is mixed into it, sometimes there are different plastic for different kind of material, more durable one, less durable one, more flexible one, or rigid one. So that is the kind of material that you want to use. So in this case, if you have a choice to use different kinds of plastics, let's say for your production, let's say if the company manufactures plastic chairs. Okay, so if you're making plastic chairs, you need to choose what kind of plastic you want to use. So in that case, the plastic is controllable cost. You can decide between different ones of them, and they will all have different prices. So that is something you can change and control. Uncontrollable would be expenses that cannot be controlled, obviously. So like rent of your building. So once you make a contract with a property company, the rent of your building is fixed. It will not be changing soon. Whereas, uh, sorry, again, other expenses that are uncontrollable. Uncontrollable would be fixed costs. Mostly uncontrollable expenses come in the fixed cost category, and something for which choice is not available. Let's say like the minimum labor wage. So if your company is paying the workers the minimum wage, then that becomes an uncontrollable cost for you. If the government prescribes that you have to pay, if you have to pay $15, let's say like in Alberta, then that becomes an uncontrollable cost. Company cannot reduce that cost below $15. They can increase it, but normally companies don't decide to, or don't try to increase the labor costs. They try to make everything work at the lowest price possible. So they will make it work at 15. Then it becomes an uncontrollable cost for them. If the government increases the minimum wage rate, let's say to 15.5, then invariably of that, the the company will also have to increase the salary and the wages to 15.5. Sunk cost. Sunk costs are something that you spent and they are not coming back. So they are not of use to company and they are not coming back either. So Let's say there is a situation where your company needs a production license. So many times what happens is, uh, especially in pharmaceutical companies, the companies that manufacture medicines, uh, there is one company that has the patent for the medicine or how the particular drug is produced. They have the copyright and patent for that. Whereas there is another company that will do the production for them that can reduce the price. So, for example, the research company would be in Europe and they will have a production center in Southeast Asia, China, India, somewhere where the labor costs are lower. So if you are operating a business in the Asian country where only the production is going on, where the license is with somebody else, you have to pay a license fee to that company. Okay, so let's say if some company has the copyright over the paracetamol formula. Okay, paracetamol is a generally used painkiller. And if a company in India wants to manufacture paracetamol or painkiller, they have to take the license permission from that company that created the formula. Like the coronavirus vaccine. So the COVID vaccine formulas were developed by majorly 3 or 4 companies in the world. Now, if anybody else wants to produce the vaccine, they have to take the permission from these companies. So how the permission works is they will grant you the license for a limited period, let's say 1 year. So they will give you the license to produce their product for 1 year and for which you have to pay a price. So on the first day of your business, you have to pay them a license cost or a license permission cost to that company. And then you have their consent to produce your product. Under this situation, the license cost becomes a sunk cost. Okay, sunk cost meaning when you pay the license fee on day one, you are not getting the license fee back. Whether you do production the whole year or whether you don't do it, it becomes a sunk cost. It is not something that is repeating again and again. So that is why it is not counted as a recurring expense, but a sunk cost will be something that is spent once and it is not coming back. So example like license permission for the year. And some businesses have to take permissions every year to run their business. For example, you have to have the fire department clearance. Some businesses like the liquor sales have to take a yearly license renewal from the government to operate a liquor or cannabis sales facility. So that cost for them becomes a sunk cost. When you start operating that business on January 1st, you have to pay a price to the government. That's a license cost for the next year. And then you can operate a business. If you decide to close your business after 3 months, you're not getting that money back, right? The money is spent for 1 year, and even if you close it after 3 months, you will not be getting it back. So those are sunk cost. Then there is opportunity cost. Opportunity cost also, I think we discussed in economics. Opportunity cost is when you choose between alternatives. So if there are uh, two alternatives or more available to you, when you choose one, the best alternative that you let go is the opportunity cost. So for example, let's take the example again of the plastic chair manufacturer. If a company manufactures chairs, they will be using between different kinds of plastics available to them. And let's say there are two kinds of plastic. Uh, one is higher quality, but it doesn't have the color in it. Okay, so they do not have the color mixed in it. Whereas the other one has the color mixed in it, and it is of a bit lower quality. So that becomes a point where companies have to choose. Do you want higher quality and then incur the expense of coloring yourself, or do you want the product that has the color already mixed inside it, and all you have to do is the molding and production of your product? So if you go with choice one, that is you use the higher quality product and then incur the cost of painting yourself, the additional cost becomes your opportunity cost. So opportunity cost will be calculated as that let's say if you had used the second product, your production cost would have been 10.8, as we saw before, $10.8 per unit. Because you chose product or the option number one instead of two, your production cost is let's say 11.3. Okay, so that is the opportunity cost of 50 cents there. Option 2 would have given you a production cost of 10.8, whereas choosing option 1 made your production cost 11.3. So the 50 cent that you're spending extra because of choosing one option over the other becomes the opportunity cost of a production. Maybe your product is high quality and all those things, the benefits are available, but still you are giving over one option for the other, and that becomes your opportunity cost. The what it means is that you had the opportunity, so you had the opportunity to produce your product at $10.8 with a little bit lesser quality of raw material, but you chose to go with the higher quality of raw material, which increase your cost by 50 cents. So you let go one opportunity for another. That becomes the opportunity cost. Then there is replacement cost. Some things have to be replaced after time. For example, machinery, most commonly. If you have a production plant, uh, many production plants for, let's say, metal manufacturers or plastic product manufacturers have molding machines and CNC machines. CNC machines are used for small metal products manufacturing, for cutting and giving out like screws, nuts, and bolts, things like that. So a CNC machine might work for, let's say, 4 or 5 years if you're operating it 8 to 16 hours a day. So after 4 or 5 years, you have to replace that thing. That becomes a replacement cost. So replacement cost is incurred to your business every 4 or 5 years, not every year and not regularly, but maybe after some period of time, you have to incur a replacement cost on that thing. Then there is conversion cost. We already saw that. Conversion cost is the cost of converting your raw material into the finished product. So that is conversion cost. Okay, at this point, let's take our break. Let's take a break till 10, 10, 10. Then we'll come back.
Thank you, sir.
Okay.
Thank you.
Methods of costing. Okay, hope everyone is back from the break. So as we discussed yesterday, costing can be of 2 or 3 types. What I mentioned yesterday was there is a production costing, then there is a contract costing, then there is service costing. Those are the three major criterias. The methods seen here, that is job costing and process costing, they are sub methods of production based costing. So if the business has a manufacturing business or a production based company, then they will be using job and process costing for their management. Job costing, however, may be used also for contractual costing. So let's look at them further. Job costing. So for job costing, costs are collected and accumulated according to jobs, contract products, or work orders. Yeah, so job costing is used for contractual businesses. So costs are collected and accumulated according to jobs. Collected and accumulated meaning that all the costs get added. Everything that you spend on that job or a particular contract gets added, meaning that they get collected and accumulated. Then each job is treated as a separate entity for the purpose of costing. Like in the contract producing business, each job is a separate entity, meaning that every house that is built by such companies is a separate entity. Then every, let's say, cargo ship they build is a separate entity. Every aeroplane that is built is a separate entity. So each job is treated as a separate entity for the purpose of costing. Cost is calculated for every job or product that they make separately. Since they are built separately, they have their different people working on them. And since you're building one product at a time from floor to top, it becomes necessary to calculate the cost of each product separately. Then this is used normally in printing, furniture making, etc. Okay, yeah, furniture is nowadays it is on production line. So cost would be like house building, airplanes, cargo ships, etc. So these kind of costings are normally done in job costing, in the job costing basis or through this method. Now, job costing has two kind of businesses under it. One is contract costing and one is batch costing. Contract we already know. The houses, airplanes or cargo ships, they are built under contracts. So the manufacturer will build one product at a time, sell it, and then move to building another one. Batch costing is used again in mostly in food manufacturing or medicine manufacturing. What they do in batch costing is every day is a separate batch. So let's say the company says they are going to produce 100,000 capsules of a particular medicine. That becomes one batch of that product. While the thing that will be produced tomorrow will be another batch. So since they carry an expiration date as to when they are produced and when the last date of consumption is, they have to name them according to batches. So what is produced today would have an expiry date for today. What is produced tomorrow will have an expiration date for according to the date tomorrow. So batch costing is used when your product is produced in batches, even though it may be same. Okay, or batches could be according to the market they are to be sold in. So the company might be producing the same product in the same plant, but under different packaging. So to sell them in different markets, the packages may be in different forms. So that makes it one after the other batch of products. So batch costing is used when you have batches of products manufactured. Or it could also be possible that every batch is different from the last one. So like many medicine manufacturers might have the same batches again and again. What was produced now will be the same thing that is produced again. Hence, that is batch costing. Contract costing. So this is applicable where the job work is big, like contract work of a building. For example, a construction company has two contracts, A and B. They are both to build a building. Not dollars. And they're going to cost $150,000 and $200,000 respectively. So these two companies, the company makes an overall profit of $20,000 on this. So what happens is the company is going to manufacture buildings, or they're going to create buildings for the customers. Now they have two jobs, that is to create two buildings, contract A and contract B. Contract A has the price of $150,000. Just the type of building they're going to produce, the company is going to pay them $150,000. And contract B is $200,000. So adding both together, the contracts are worth $350,000. Now the company makes a profit of 20,000, and how is it made? We look at the particulars here. That is, the material cost for the company was 225,000. Labor cost was 55,000. Other overheads were worth 50,000, and the total cost came out to be 330,000. So since the income is 350,000 on selling both the buildings, and the expenses are 330,000, the company made a profit of $20,000. We can look at them individually here. So even though the company is making a $25,000 profit on contract B, and there is a loss of 5,000 on contract A, overall they are making $20,000 in profit. So now we have bifurcated contract A and contract B, as these are the company's two contracts. So contract A gives the company $150,000, contract B gives 20,000. And you can see the costs below that. There is material cost, labor cost, and other overheads. So this is the general structure of a cost statement. Generally, when you make a cost statement, they will be in this form. That is, there will be material costs, there will be labor costs, and then there will be overall other overheads, excluding both of these. So all your costs add up to become the overall cost for the company, or the total cost for the company. And you reduce cost from the revenue. What you get is the profit or loss for that time. So we will be making these kind of statement when we are solving problems, but they will be a little more detailed. So the questions will have more details than this. Batch costing. Batch costing is used when a number of similar units are made, but it comprises of batches. So as I said, like medicine companies, they have batches. They have to affix an expiration date on every product. So at the end of the day, the batch is closed and the expiration date is changed to the next day when the next batch is produced. So batch costing, a lot of similar units which comprise of a batch, which comprise the batch, a cost unit for a certain amount of cost. For example, ready-made garments like TV sets and drug industries. Ready-made garments and TV sets and drug industries. They manufacture in batches. Then there is process costing. Process costing is used in manufacturing plants. So something that is manufactured on a continuous basis on maybe an assembly line or through a process is called process costing. So this is done for continuous operation or continuous process costing. This is applicable where goods and services pass through different process to be converted into finished goods. Example of this is sugar industry, textile, chemical industry, and anything that has a manufacturing process. While the raw material passes through the different processes, it is converted into the finished product. So applicable for goods and services. No, it's normally applicable only for goods. So process costing is used in a manufacturing plant where the product or the raw material will pass through a number of processes and then get converted into a finished product. Example is similar to what we saw for contract costing. So we do not direct process given a to bifurcate them in the same way. So the process may be any way or anything that is going on in the background. What we see for cost statement is the raw material consumed for the process is 7,500, labor cost is 8,750, and production overheads are also 8,750. The total cost for this company is 25,000. Okay, it says the product sugar is obtained after going through three processes to produce 500 units of product X, total cost incurred. So they are manufacturing sugar and they are producing 500 units of that. 500 unit could be like 500 bags of sugar. So the costs incurred all added together added up to be $25,000 for the company. So $25,000 for 500 units means $50 per unit of product that they produce. Now here we have the same process, that is production of sugar. Again, classified into the three processes that are involved. For example, that is process number one, that is extraction of juice from sugarcane. Then there is process number two, clarification and evaporation of juice. Then next is crystallization and centrifugation for sugar. So that's how sugar is produced. And every process has a cost. That is the extraction of juice, evaporation of juice, and then crystallization to make it sugar. So what they showed here is you have different cost at every stage and they add up to be the total cost of the product. As you can see in this slide, the extraction of juice from sugarcane, that stage involves raw material worth 3,750, labor cost of 2,125, and other expenses of 2,125. They add up to $8,000 for producing the batch, or that is 500 units. Then process B has a cost of 10,000. Process C, the crystallization, has a cost of 7,000. So each process has their own cost that then later on becomes the total cost, that is 25,000, as we saw in last slide. So we can see 8,000 if that's the cost of process one and you're producing 500 units. We can easily calculate that the cost per unit is $16. Then process two has their own cost that is of $10,000. That if you're manufacturing 500 products, that cost will add up to be $20 per unit. Dollars. And same for process three. That is the cost is $7,000, and we are producing 500 products. That adds up to be $14 for the total production. So that is our introduction to cost accounting, or what cost accounting is. So we saw there are two types that they are showing here. One is contract manufacturing, contract costing, and the other is job costing or process costing. I will now mark the attendance for you guys. So just give me 10 minutes for that. Okay, let's see if there are examples to solve on the curriculum or on Brightspace. Okay, so here are some questions for us to make us busy. The review problem from chapter 1 on Brightspace. So the question number 1 says the following are the manufacturing items. Following manufacturing items are for a construction company working on several custom homes. Okay, so they make or create custom homes. Identify whether each item should be categorized as direct material, direct labor, or manufacturing overhead. Okay, so I want you guys to identify them now, right? Like just as we did in financial accounting, identifying whether a transaction is an asset, liability, income, expense, or equity. We have to identify if these expenses are direct material, direct labor, or manufacturing overhead. So nails. Who can answer that? Where do nails belong?
Direct materials.
Nails would be, yes, direct materials. So they are used in making the house, right? Then lumber.
Direct
Direct
material.
materials too, sir.
Okay, yeah, lumber would be direct material too, because that's what a house is made of. So it's a material consumed in making a house, right? And then drywall.
Direct materials.
Materials.
Okay, that is also material, right? Tangible things that are used in making our product. Then workers building the house frame.
Direct labor.
Direct labor.
Labor, right? The wages paid to workers building the house frame. That is direct labor. Then supervisor responsible for 3 homes.
Direct labor.
Direct labor. Overhead.
Labor. Uh,
Or
it's,
manufacturing overhead.
no, it's direct labor, not
Direct labor.
manufacturing. Yeah, it's a person, right? It's a
Yeah.
person
Yeah, it's a
involved
person.
in creating our product. So the person involved would be a direct labor. Then the light bulbs for the house,
Direct material.
Direct materials.
direct material, and cabinets.
Direct material.
Materials.
Cabinets also direct material. Then finally, depreciation of construction equipment.
Manufacturing overhead. And
Manufacturing overhead. Yes, it is not a material and it is not direct labor also, but it is a construction equipment that depreciated, right? Yeah, in cost accounting, we do put this under operating expenses, but here it is a manufacturing overhead. It's a manufacturing overhead, okay, since we are given the three categories. Depreciation of construction equipment is a manufacturing overhead. It is a replacement cost, that is money set aside by the company to buy new construction equipment when this one stops working. Okay, so those are the answers. If you want, I can write them here. Or should I write them somewhere else? Okay, they have the answer here. So they have put nails under manufacturing overhead. Why are nails put in manufacturing overhead? Direct materials. Number 5 is supervisor. Supervisor was a confusing one. We put it under direct labor. But the benefit of tracking this item as direct material probably does not outweigh the cost. What does that even mean? Okay. So they classified nails, supervisor responsible for the 3 homes, and light bulbs as a manufacturing overhead, but they are not. They are labor. Nails are something that are used, just like wood is used in making a house, nails are used. So it is not manufacturing overhead. Okay. So for our easier identification, we will put the products that are used in manufacturing or making the other product under direct material. So raw material would be anything for a house here. Wood, nails, cabinets, everything is a material used in making the house. So nails would also be counted as materials. So here they have again items that has to be classified into product cost or period cost, or in simple words, manufacturing cost, let's call them direct or indirect. Also indicate whether the cost should be recorded as an expense when it is incurred or as an expense when the goods are sold. or whether the cost is incurred as expense when the goods are sold. Okay, so direct cost or indirect cost, that is our classification, and question number second. So advertising, is that a direct cost or an indirect cost?
Direct.
Indirect.
Direct cost is again, if we clarify, let's say it's a production or manufacturing company. Direct cost is only the cost that is incurred in creating our product or converting our raw material to the finished product. So converting our raw material to finished product is a direct cost. Other costs are all indirect costs. Okay, so advertising is not an expense incurred in our conversion.
Indirect, sir.
Yes, it is indirect. But why? Because advertising is a post-production expenses. You make your production and then you sell it via advertising. So advertising has nothing product. Second is shipping cost for raw material coming from a supplier.
Direct.
Indirect.
Both the answers. Okay. Shipping cost for raw material is direct cost.
Because there's materials from the supplier.
Yeah, so this is raw material that will be needed to make your product, right? So when you need material to make your product, that is the raw material, the shipping cost for that is a direct cost. But number C is the shipping cost for goods shipped to a customer. What kind of cost are those?
Indirect.
Indirect.
Indirect, right? Because the product is already made. So cost incurred after the product has already been made, they are indirect costs. They don't have anything to do with production now. Shipping for raw material has to do with production because unless you pay the shipping cost for raw material, your production is going to stop. So in order to keep it running, you have to pay a shipping cost, acquire the raw material and do your production. So item number B, shipping cost for raw material becomes a direct expense, but item number C, shipping cost for goods shipped to a customer, becomes an indirect expense because it has nothing to do with the production. Then chief executive officer's salary.
Indirect.
Indirect.
Yes, this is the CEO salary. It is indirect, right? CEO doesn't work on the shop floor. They are not indispensable to the production. Production will go on without a CEO also. Mostly CEO would be involved in marketing and advertising of the product. So this is an indirect cost. Then production supervisor's salary.
Direct.
Yeah, production supervisor salary would be direct because he is a person involved in production, or he is the person that you are involving in for producing the product. So it becomes a direct expense. Number F, depreciation on production equipment.
Direct.
Indirect.
Okay, yeah, this could be confusing, obviously, because when we made the financial statements, depreciation was in the operating expenses. So we were putting those in indirect, right? But depreciation on production equipment will be a direct cost because it is the equipment used in production. If it was depreciation on office building or depreciation on office equipment and furniture, that would be a indirect cost because it has nothing to do with production. But this is depreciation on production equipment. So since that equipment is required for our production, the depreciation will be a direct cost. Equipment like or office furniture, they are required for your manufacturing. So depreciation on production equipment is a direct cost. Then the raw materials used in production.
Direct.
Direct. Yeah, this would be direct, right? Raw material, without that, your production cannot carry on. So raw material used in production will be direct cost. Paper used by the accounting staff.
Indirect.
Direct cost.
Indirect, yes. So paper used by accounting staff is is an expense that is incurred by the office management or the office staff in a company. Even if you don't have accountants, you can outsource your accounting process. It doesn't affect the production. Or accountants don't work in your production process. They work in the company management. So that is an indirect cost. Then commissions paid to salespeople.
Indirect.
Indirect.
Indirect, right? Because those people are selling your product. They have nothing to do with production. They don't produce the product. So commission paid to salespeople is indirect. Next is janitorial services provided for production facility.
Indirect.
Indirect.
No, these are direct. So janitorial services for production facility is a direct cost. So cleaning the shop floor and maintaining the shop floor, that is a direct cost. Janitorial services for the office or management area would be indirect cost, whereas this is a direct cost. So janitorial services for production facility. Let's see what they say about it. Number J. Product costs expensed when goods are sold. So it is a direct cost. Then number K. Supplies used by human resources personnel.
Direct.
Indirect. Human resources personnel again is the company management, like the HR department of a company. Right. So if you are still having confusion, please sound it. If you don't understand any of the point that why something was calculated as direct or indirect, just imagine in your brain that there is a production plant in a land, and then there is an office building just beside it. Every expense that is made in the production plant is a direct expense. Expenses that are made inside the office building are indirect expenses. So that's something that helps you visualize. There are two buildings, one is for production and one is for office. Today is what Tuesday, right? I have to send the score for marketing today. Then I'll start with your result tomorrow. Right, so it should be available day after tomorrow, that is Thursday. I'll send you a score by Thursday then for financial accounting 1.
Thank you, sir.
Okay.
Thank you.
Yeah, so that's all for today. We are done quite early actually.
Okay, thank you, sir. See you tomorrow.
Okay,
Sir,
see
thank
you.
you. Tomorrow.
Thank you,
Thank you very
sir.
much.
Bye.
Bye,
Yes,
sir.
sir. Bye.
Bye.